This is Ramit and welcome to my presentation on margin in term loan part 1. In this part of the presentation, we will learn some basic concepts on margin in term loan. The more advanced topics will be covered in the subsequent part of this presentation. So friends, what kind of loans are covered in this series of presentation? We will cover the MSME loans and the project finance for large corporate borrowers. Now let us see what are the things you will learn in this presentation. We will learn what is a margin, the importance of analyzing sources of fund, equity or capital versus unsecured loan, stages of assessing the margin, tools for assessing the margin, and finally, how to safeguard your bank's interest. All this will be covered in my series of presentation. But let us begin our discussion with what is a margin. Let's start our discussion with a case study. You have financed a project of 200 lakhs where margin is stipulated as 20%. What does it mean? It means bank loan is 160 lakhs and capital or equity of the promoter is 40 lakhs. Margin of 20% means the promoter's contribution in the project cost is pegged at minimum of 20% of the project cost, that is 40 lakhs in this case. So the bank finance should be restricted to 160 lakhs and capital or equity that has to be brought in by the promoters should be 40 lakhs. I hope this is clear. Now let us continue with our definition of margin. In our earlier example, the company has approached you for releasing a loan of 20 lakhs. Now can you tell me how much promoter's margin shall you ensure? Is it 4 lakhs, 5 lakhs, 8 lakhs or none of the above? Now the correct answer will be 5 lakhs. But how? 20% of 20 lakhs is 4 lakhs only, isn't it? So how come the margin is 5 lakhs? Let us once again get back to the basics. Just now we have learned that margin is always on the overall cost. Since the company is requesting for 20 lakhs disbursement, we presume that the anticipated expenditure will be 25 lakhs, of which 5 lakhs should be brought by the promoters and the balance amount of 20 lakhs should be financed by bank. I hope this is clear. Always remember that disbursement is never equal to expenditure. Disbursement is always a percentage of the expenditure, and in this case the percentage is 80% only. So friends, when the margin is to be brought? Margin can be brought upfront, that is before any kind of disbursement. This is applicable for one-time purchase of machineries or fixed asset. Or margin can be brought in a phased-wise manner, that is along with the implementation of the project until the commercial activity commences. So whenever there will be multiple disbursement associated with a term loan, margin shall be always brought in a phase-wise manner. Now, what are the things you have to ensure? Simply requesting a release of 20 lakhs means nothing at all. The company or the promoters must submit an estimation of 25 lakhs clearly stating the nature of expenditure they are likely to incur. This information has to be cross-checked with the sanction terms in order to verify that expenditure quoted by them are at all eligible for finance. The company or the promoter has to deposit 5 lakhs in the account maintained with you, and a combined NEFT or RTGS of 25 lakhs shall be initiated after disbursing rupees 20 lakhs of loan from his loan account. Now let us quickly glance what are the expenditure eligible for finance. For this you have to understand a concept called hard cost. This is nothing but mainly comprising of the construction cost, plant and machinery, electrical installations, and furniture and fixtures. There is also something called a soft cost, which is comprising of interest during construction, preliminary and pre-operative expenditure, patent, or technical know-how. Now, items which we consider as primary security are taken as hard cost. For remembering purpose, you can consider them as items which you can touch and feel. I hope it helps. Banks are generally financing the hard cost only, until and unless specifically permitted by sanctioning authority to finance the soft cost. Always remember that the financing of soft cost is involved with very big size projects, 100 crores or 200 crores. Generally, no bank is financing the soft cost. Now comes the bitter truth. Most of the companies we deal with have no idea how to request for a release. They feel that their term loan account is just like a cash credit or OD account. They straight away walk in with the RTGS or NEFT form, and sometimes even without the seal of the company. So what is the solution? Let's educate them. In my earlier days of credit, I used to prepare extensive disbursement schedules by collecting the necessary documents from the customer. Now that is a very cumbersome process. As a credit officer, you have to take care of 10-15 accounts at a time where disbursement are taking place simultaneously. However, from the company's point of view or the promoter's point of view, they are the owner of only one account. So it is quite easier for them to present the case properly in front of us. If you educate your customer how to prepare a release schedule, how to request for a release, I think 80% of your job is done. I have prepared a release request format that I generally provide to my customers, and they give the request in this format. I will give the link in my description. In the description of this video, you can download this format from there. It is just a sample request by a company. It says that release request of term loan. We request you to release a 20 lakhs from our sanctioned term loan of 200 lakhs. We request you to collect our margin of 5 lakhs from account XXX maintained with you. Computation of our margin and releases availed so far are enclosed with this letter. Now let us glance to what does the annexure speaks. The annexure says about the disbursement made so far. It has all the elements that you need for recording the transactions. And it also speaks about the present request. Finally, it it says the total disbursement of the term loan including the present release, promoter's margin brought so far, total payment made to the vendors, and overall percentage of promoter's margin. Don't forget to get a signature with the seal of the managing director or the partners, and always get it signed by your branch head or whoever is in charge of the branch. Now, as we come to the end of this presentation, I will leave you the GOOGLY. This is a live case in my branch where I faced a strange situation, and so I call it a GOOGLY. We have financed a loan of 85 lakhs with a margin of 25% for scaffolding materials, mainly used for construction of buildings. The loan was yet to be released when the promoter made an advance of 2 lakhs to the vendor through his current account maintained with us. This was to be considered as margin at a later stage. He came with a first release request of 3 lakhs. We did not collect margin this time since he already paid 2 lakhs upfront. He was so happy. Next, he came with a second payment request of 7 lakhs, where he computed his margin all on his own, as discussed in the next slide. You remember, I always try to educate my customer, but this time the customer tried to apply my education on myself or my bank. Now I will present the calculation which was given to me by the customer. I call it a reverse sweep. Amount invested so far by the customer 2 lakhs. Bank release so far is 3 lakhs. Present payment request is of 7 lakhs. So the margin till date should be 25% of 10 lakhs. That is 2.5 lakhs. Since he has already paid 2 lakhs, we have to collect a balance amount of 50,000 only. This was his version. It looks apparently right, correct? So, what is your opinion on the above calculation submitted by the party? I will keep this discussion open and I will answer this reverse sweep in the next of my presentation. I hope the basic concept of margin I was able to clear, and I will be covering the more advanced topics in the few next series of my presentations. I thank you all for listening. Have a good day. Take care. Bye.